AT&T is offering a yield of 6.9% currently. Is it undervalued, and should we be taking advantage of a stock that could be nearing the bottom? We're going to find out the answers in today's episode. We're going to take a look at the historical data and performance of AT&T. We're going to jump into their revenues and see how it has performed over the last 5 years, as well as taking a look at that bottom line, the net income and the balance sheet, the total cash versus total debt. And we're also going to take a look at the dividend safety. Can they continue paying that dividend alongside paying off the interest and debt? And as always, we're going to end the episode with our stock valuation model, finding out the intrinsic value and finding out our acceptable buy price given our margin of safety. Now, year to date, it is down 14%. It is offering a yield of just under 6.9%, and it is right there towards that 52-week low. Now, for the shareholders who have been holding AT&T for the last 10 years, you would be down 40%. Holding a stock for 10 years, you do not want to be down at all. In fact, you want to be up by more than 100%. And that doesn't include dividends reinvested. Now, in terms of their financials and their revenues over the last 5 years, typically we like to see slow, moderate growth around 3 to 7%. We can see here in December 2018, they reported revenues of 171 billion. And in December 2022, we can see here 120 billion. So the revenues have decreased over the period, and you could argue that part of that is the spin-off, I believe, of the Warner Bros. I don't have the exact details, but what we can see, however, is that it has decreased. It seems to just be the trend. Now, one thing I would note about this is we need to see how that has affected the bottom line. Now, when we take a look at that bottom line, their net income, as we can see here, has gone from 19.4 billion. 2022, 8.5 billion loss. So it's not surprising to see the struggles of the company, why they are down year to date, and why the company has been continually in that downtrend over the last 10 years. Also to point out, they have made a loss in 2020 as well of 5.2 billion. So a lot to consider here and a lot to understand as we move forward. Now, what I want to take a look at is that dividend safety and some very important financial metrics. So currently the dividend safety is sitting at 70, making it safe. Market cap of 115 billion, making it a mega cap. Now, taking a look at some key metrics here. Dividend streak, 0 years without a reduction. This, as we're about to find out, is due to the fact that they did do a recent massive dividend cut. Now, for those who believe we are heading into a recession, just a few facts to note. During the last recession, 07-09, they increased their dividend. They also had recession sales fairly flat, negative 1%. However, this was above the average growth during the last recession, which was negative. And although they had a recession return of negative 45%, this still beat the S&P 500's negative 55% return. Now, it's never great when a company cuts their dividend, and what we can see here is a 0% increase since March 2022, negative 11% year on year over the last 5 years, and 0% growth over the last 20 years. So in fact, there is really nothing positive to say so far about the dividend. One thing I would say though, for those who are new to the channel, you are looking for a minimum of 4% increase in your dividends, your salaries, and other income producing assets. The reason for this is because the US inflation rate over the last 40 years was 4%. So if you're getting less than 4%, you are losing your purchasing power and taking a pay cut. Now, dividend yield theory states that a company is undervalued when it's sitting above that 5-year average in terms of the yield. So currently, I would say it's fairly in line with that 5-year average, just a few percentage points out. So it looks reasonably valued based on this theory. Again, we don't look at any model in isolation. We draw our conclusions at the end of the video. Now, forward PE, likewise with that, when the forward PE is sitting below the 5-year average, the company can be undervalued. So this looks like there is a sign of undervaluation solely based on the forward PE. Sector PE at 16.2 with AT&T at 6.6 does show some undervaluation. And the 52-week price range, as mentioned, is heading towards that 52-week low, but it does not mean it's undervalued if it's at the 52-week low, nor is it overvalued if it's at the 52-week high. Earnings payout versus free cash flow payout. We look at the free cash flow as the earnings is susceptible to manipulation by management through accounting. I personally like to look for below 60% is one of my 7 golden dividend metrics. Do go check out my 7 golden dividend metrics in my pinned YouTube video. The reason for 60% below is so there's room to grow double-digit dividends. Now, what we can see here is based on the earnings payout, it has been below 60% for a number of years, but also has creeped up to around 70-75. Not the worst in the world because it's below 80%, which is probably what I would consider a red flag indicator. For me personally, everyone has their own views. Free cash flow, what we can see here is since around 2018 onwards, it has been below 60%, other than 2022 where it slipped slightly higher. But 2023 is going to drop down to 41%. So with this, I can understand why there is a sense of security currently with the dividend. Earnings per share, I do prefer to look at the free cash flow per share, but I would say on the face of it, a fairly similar story. 250 in 2013, 257 in 2022. Really no growth over the last 10 years. This is why I like to look at a set of data for 10 years, as you can see a good overview of the business and the way they operate. 2023, it is expected to decrease. Not positive at all, especially since 2013, it was higher. Likewise with the free cash flow per share, 253 in 2013, 173 in 2022. So in fact, it has decreased. Now 2023 is expected to go up, but we can see even if it hits 270, there really is no growth over this period. Sales growth, like I mentioned, steady moderate growth, 3 to 7% year on year. Realistically, they only really hit that for a few years. 2020 onwards has been really difficult in terms of the sales growth. Again, some of that is due to their spin-off with Warner Bros. Now, total sales, you can really see the above picture below. 129 billion in 2013, 121 billion in 2022. Picture really speaks for itself. We do need to see how they do go forward in 2023. And at the moment, there isn't too much to be positive about. Now, what I would say is, before we go on to the shares outstanding, what we're trying to identify here is if this company is undervalued and if this is at the bottom. I guess in terms of their share price, if they have hit towards the bottom, this company will be different for different investors depending on your risk to reward ratio. Now, shares outstanding, 5.39 in 2013, 7.17 in 2022. Typically, we prefer it when it's a declining graph, as it means companies returning excess cash to shareholders, which is essentially beneficial to the shareholders. Now, they've done the complete opposite. In fact, they've actually issued shares and they've diluted your position as a shareholder, so never really positive to see. Now, return on invested capital, again, another one of my 7 golden dividend metrics. What I like to see is around 10% plus, and other than 2013, it has been below that. I like to see 10% plus, as it means management are able to effectively allocate their capital. Operating margins above 14% for telecoms. They've at least managed to do that consistently. Free cash flow margin above 7%. Again, they've managed that consistently other than 2021. Slight worry, but looking forwards, just need to ensure that they continue to keep this up. Now, the final one, and probably the most important one for me anyway, is their net debt to earnings before interest, tax, depreciation, amortization. Below 3.5 is what's ideal for telecoms. What this means is, if we take a look at 2022, it would take AT&T 3.47 years to pay off their debt net of cash on hand. What we can see here is essentially from 2019, this is going upwards, and 2023, 3.46. Not really ideal, is right on there on that border line that we look for, and it has been increasing. So again, something just to take a look at in their next quarterly and annual reports, as you do not want this going upwards and higher, as not only will this affect their ability to pay their debt, but also to pay that dividend. This essentially showing us that in 2022, 60% of the company's financing was from debt as opposed to equity. Now, before we jump in the stock valuation model, if you've been enjoying the content, if you're getting value from this, do smash that like button. Do hit that subscribe to be continually notified for these videos and when they drop. If you do want to grab a copy of the stock valuation model to run your own companies through, do check the pinned comment and grab yourself a copy. And also do click the link to join us on Patreon. Now, Graham's valuation, what we can see here is, if you take a look, the earnings per share for AT&T, in fact, isn't 0.8. What we've done, because it's negative, is take the average of the last 3 years as 2023. The trailing 12 month is 1.18 negative. So we have 0.8. So do bear that in mind moving forwards. Growth rate as per analyst estimates around 21, fairly high. Current yield on AAA corporate bond gives us an intrinsic value of $20.84. If we have a quick look, we can see this is higher than the current trading price and just below that 52-week high. Now, typically with the multiples valuation model, I'll have a minimum of 3 companies here that we'll take a look at, similar sector and industry size. But unfortunately, as only I would say Verizon is really comparable, I won't be using this valuation model. But purely for educational information purposes, if we did, we'd get the stock prices over the earnings per share to get our P multiple and multiply the average by the EPS. Now, for this, it would give 581. But as I mentioned, given there is only one, we're not going to go ahead with this model in our intrinsic value calculator. Now, the dividend discount model shows us the yearly dividends year on year that AT&T has paid out, and we can see here this recent dividend cut gives an average growth rate of negative 8.13%. Moving forwards, I've gone with an estimate on average 2%, roughly what they were increasing year on year before they decided to cut. And this gives a DDM price of $18.87. Again, slight upside to that current share price. Now, the final model, the discounted cash flow model, where we have our free cash flows, we can see the growth rate year on year, which comes to an average of 5.4%. Now, moving forward, slightly lower than analyst estimates. We've gone for 4% to be more conservative, which is also lower than the average growth rate over the last 10 years. And using our discount rate, we get the present value of these future free cash flows with that terminal value. Now, once we add that together with the cash and cash equivalents, subtract the total debt, and get to our equity value, we divide this by the shares outstanding to get a DCF price of $24.32. Again, showing upside to the current share price and just slightly above that 52-week range. Now, if you have been enjoying the content, do hit that like button, do hit that subscribe button for continued content. Now, the intrinsic value is essentially the average of the 3 models we have just run through. This comes to $21.34. Now, the current share price is sitting there at $16.12. Now, margin of safety, typically you hear me say around 10% minimum margin of safety for strong companies, good financial data, historical data, future forward guidance, and wide moats. Now, I don't believe AT&T is any of those, but for those who do like a 10% margin of safety, your acceptable buy price would be around $19. If you wanted a margin of safety of 20%, which I would say is the minimum margin of safety for a company like AT&T, your buy price would be around $70, making it a current buy. Now, if you wanted a bit more of a margin of safety, around 25% for this company, which I think is probably justified, you would be looking for a buy around $16, which is essentially where the company is trading at, and it is within that 52-week low range. So I would say around $16 would be an acceptable buy price. Now, my personal opinion on this company is that I wouldn't be buying at these levels purely for the risk to reward ratio for this company. But I'm interested to hear your thoughts in the comments. Do let me know if you're looking to buy, sell, or if you're on the sidelines. Now, Wall Street forecast the price for the next 12 months to hit $22, which is nice upside to that current share price and is essentially in line with our intrinsic value. As always, let me know your thoughts in the comments. Are you looking to buy, sell, sitting on the sidelines? And as always, have a great day and catch you on the next one.